Hey guys, welcome to another Trade Genius podcast. I got my good friend Bob here, and we are going to talk about why this time is not different. Let's dive in.
Trade Genius.
Well, Bob, I've been hearing some complaints, not complaints, but just some thoughts that, we had rate cuts in the 90s and the markets didn't freak out. And we actually ended up grinding higher all through the 90s, culminating in a year 2000 blow-off move with the tech bubble. But there's a key difference in that, isn't there?
It's a totally different environment than we had before because, going into the tech bubble, there was the event, right? Y2K, and people were investing right into through that. And also the internet was new and it was a brave new world. We have none of that today. And plus we have demographic issues and the global environment is different too. So we're back to normal. And if you know, and I've been seeing it too, people are just getting into origami positions saying that we're not going to get a recession. It's a soft landing. Fed got everything under control, but the data simply doesn't suggest that. It's basically telling us that, unemployment and job openings are collapsing, employment is collapsing, and the consumer is in deep debt. And the other thing too, Phil, we have inflation coming up where you didn't really have that in the 90s. Yep. So we have all these things that are different that you can't compare that time period and use that as part of your statistical, justification. So there's no doubt in my mind, you could throw a lot of money at this problem, but you can't make companies hire people and you can't make people spend and you can't make people borrow. So if you notice this chart we have here, it's just setting up once again. Look, if everything was fine, the Fed would be under zero compulsion to lower interest rates. They only lower interest rates in hindsight. And they're talking about another 50 basis points because they know. And look at China. Watch China. If China throws all this money at the problem and they can't get people to spend or to borrow, then we have what's called the string push phenomenon. And then it's basically Katie bar the door. It's all she wrote. And I think that's what we're setting up for here. We have to clear this excess out of the system. And unfortunately, it's going to come on the backs of people. And we're going into a political environment, Phil, Trump becomes president again, he's going to be clearing out a lot of federal dead wood. You're going to see a lot of federal employees retiring, if you know what I'm saying. And, you're not going to get this spending like you had before. So I think this next recession is going to be very, very sharp and it's going to catch a lot of people off guard because everybody's expecting that the Fed has got this glide path down pat. And I totally disagree. Hey everybody, it's Bob with Trade Genius. Usually I do fun ads. I talk about our service, but I want to be serious with you for a second. We've been helping a lot of people trading for a long time. As you can see here, I want to let them do the talking for me for a change. But most importantly, we want to help you too. If you've not joined our service yet, come check us out, tradelikeagenius.com. Full service. We have chat room. We have the algorithms for you. We give trades out every day. We educate you. So go to tradelikeagenius.com. Check us out. What you get out of our service is much, much more than what you put into it. And we'd like to see you in the room. Thanks for listening.
Yeah, and the other thing I would add too is that in the 90s, you actually had low unemployment and the unemployment numbers were coming down. So it's different because as you can see on the chart here, we have that, like we talked about that rounded bottom phenomenon, right? So unemployment is coming up, right? In the 90s, unemployment was low coming and so it's a totally different job picture than what we have now. And that's a key difference as well. And the rate cuts was just they were dealing with a different dynamic at that point. So I don't think it's the same like the 90s, totally different picture when you put all of those components together. Contextually, it's just not the same. And so I don't know why you would expect a soft landing here. The other thing too, we don't have up here, but the yields, right? The 2-year yields, a lot of times when you see the 2-year yields diving, and that's why a lot of the economists are saying the Fed is late, is because the 2-year yields have dropped so much and the Fed was lagging. But I think the Fed was lagging because they're dealing with, like you said, there was no inflation problem back then as well. And I agree with that. And that is a big difference here too. And I went back and looked at that, and like we have core PCE coming on Friday, right? And that number, I noticed the Fed is not into easing or doing any kind of QE until that number is firmly back within the 1 to 2% range. If you go back historically and look at that, we can probably do that on another video. It's very clear that there is absolutely no accommodation and no easing until that number is back in that range. So for people that want to say that the Fed or the powers that be are not going to let this market drop ever again, that's just not how it works. They have certain things that they adhere to, and they're not going to do that ahead of where they feel like inflation is under control. Because otherwise, if you have rampant inflation, forget it, right? I mean, everything goes out the window, and it's really like, Powell a couple years ago at Jackson Hole said there's going to be pain if we don't get this under control, and that is exactly what's going to happen. So I think a lot gets lost in the mix with markets going up, and the big picture kind of gets lost, but I don't think much has changed. I think we're heading to a top here, and I think unemployment is going to continue to rise, and I don't think you're going to see the Fed step in until they feel like core PC and all these other inflation metrics are well within normal bounds that they can get away with another round of easing. And then, but they will do it again. It's going to come and it's going to happen again, but they're going to wait until inflation eases, because if they get to work on that too early and come in and stick save things too early, then they undo all the progress that they've been trying to make basically since the end of 2021.
Yeah, look, I think China's going to suck all the commodities back into China. It's all going to firm up all those prices. And if they get oil demand up, you got energy going up too. I know this is anecdotal, but I live in probably one of the wealthiest places you can live in the world. And we took a walk this morning, went to the grocery store, and we were just astonished how empty the shelves are. So the companies are not restocking their shelves. And I mean, in an area that shouldn't be poor. And then my wife went to CVS and she said, I got to go get this stuff when it's in, because half the time they don't have what I want because the stores are barren. And part of that's a game they're playing. They're basically trying to make the next quarter, this quarter that's ending here, they're trying to make it look as good as possible because they're just not spending the money. They're trying to suck the revenue, and profit line up. Because, reason why Boeing's in trouble is because they're cutting so many corners now because they got to keep making that EPS, and they're running out of room in games to play. And the other thing we're seeing, Phil, is that, these restaurant chains are blowing up. And I just read today that layoffs are starting to accelerate. And so people are trapped. I mean, they're going to lose their job, and they're going into the Christmas, supposed to be the highest retail rates of the year. And that's starting to blow up on people too. And then I look at my wife's company as a barometer too. And I never seen such an up and down business cycle that she's had this year too. So, again, we're starting to soften again. And this is supposed to be the time when a lot of people are setting up travel for the holidays, and it's just not the same as it was. And people have to work with my wife 60, 90, 120 days out, in order to have her time, and she's not full. And so it's telling me even the upper echelon people are just not spending money. So I think people are deluding themselves if they think they understand this business cycle. And I think they just have to look at Japan in 1991. And I think that's what we're tracking here, because, when a lot of people that are losing their jobs now simply may never come back to the job market because they're going to be old enough to bridge to Social Security. And so I think it's going to be an environment where I think it's going to catch a lot of people off guard.
I would agree. Guys, let us know if you agree. Are we going into another 90s type scenario, or is this like the last couple of times where we had unemployment rising, like in 2000 and 2008? Thanks for watching, guys. Thanks, Bob, for the input and the chart, and we will see you guys on the next video. Take care.
Trade Genius.